Hi, I'm Ross Mayfield, investment strategy analyst at Baird, and we are back for another weekly update with our friends at Strategas. Today, I'm thrilled to be joined by Thomas DiFazio. Thomas is a research analyst at Strategas. Thomas, how are you doing today?
I'm great, Ross. Thanks for having me today.
Thrilled to chat with you. For people who don't know, a big part of your work is working on the sector and global asset allocation efforts for the firm. So I thought we would start there. Looking backwards a bit to some of the changes that you all made at the back end of 2023, could you go through those and describe the impetus for the changes you all made?
I'd be happy to. We ended up making quite a few changes in the back end of December here. So I'll start at the sector level, and then I'll talk about how that went into our global asset allocation thinking. At the sector level, we started with upgrading consumer discretionary to overweight, we upgraded communications to overweight, and we upgraded financials to neutral. On the negative side of the ledger, we downgraded energy to neutral weight, and then we downgraded consumer staples to underweight. Overall, this is getting a little bit more of a cyclical tilt within the sector allocation. As I hinted at, this helped inform our global asset allocation positioning as well. We ended up taking 200 basis points out of cash, and we ended up taking 200 basis points out of bonds. We took that 400 basis points and we put it into equities, and more specifically, large cap growth. We acknowledged the strength that happened within the large cap growth space, especially in the fourth quarter of 23. And ultimately, we felt that with the data being as strong as it was, and acknowledging the concentration risk and the strong momentum that has accompanied it, we felt that it was appropriate to get back to neutral on large cap growth.
Yeah, I think that makes a lot of sense. We had this big rally at the end of last year, and you all are taking the opportunity to kind of lean into that strength and momentum and get a little more pro-cyclical as the economy continues to be resilient. As we sit here at the beginning of January, the market is chopping a little bit, not really sure what it wants to do, it would seem. Do you all have any changes to either sector or global asset on the horizon for January 2024?
As discussed, we made a lot of moves, and we're not ready yet to walk back on any of them. We think that these bets and these ideas need a little bit more time to develop. We're going to stay unchanged in January. But I do want to emphasize that we are on the cautious side of the spectrum, even though we did, on the margin, get a little bit more, move from cautious to bearish to cautious to bullish. I want to emphasize that cautious point. And I really would think about really two main factors that help inform that thinking. Number one, we still have the conflicts that are going on within the Middle East, and we also have now these supply chain complications that are coming about as a result of these Red Sea issues that with tankers getting attacked. We think that this could ultimately translate to could help contribute, I should say, to some of the issues with inflation, and could help catalyze a second wave of inflation, which ultimately is something that we're staying on guard for and that our economics team has been continuously on the lookout for. As a result, we do like the biases that we have in our equity side of the portfolio. We like large cap value over large cap growth, and we think that value could have its day if that second wave of inflation were to come about this year.
Yeah, I mean, look, it hasn't been that long since we've seen what supply side transportation issues can do to inflation when COVID-19 kind of shut down shipping lanes and shut down ports and factories. So something to keep an eye on for sure. Another thing to keep an eye on in 2024 would be the presidential election. We're still several months away, but obviously the rhetoric and talk is starting to ramp up. In addition to your sector and asset allocation work, you do a lot of work on the firm's factor effort, which is looking at styles and types of stocks that do well in different environments. And you did a study on what factors work in presidential election years or have worked in those years. Could you talk about that a little bit for us?
I'd be happy to. In a presidential election year, there's a lot of uncertainty, and that is reflective in the factor positioning. As investors are trying to handicap whether the incumbent is going to stay in office or a challenger is going to win the presidency, that leads to some uncertainty. Investors don't like uncertainty. So ultimately, investors tend to lean on more of the high quality factors when building out their portfolios. They look to high margin, high free cash flow growth, as well as high ROE and high ROIC. Really just to help avoid some of the riskier corners of the market. You're not going to typically see high beta and high short interest carrying the flagpole of leadership during these election years. And I just think that is emblematic of the uncertainty that accompanies the new election cycle.
Yeah, absolutely. There's going to be a lot of headline noise, a lot of volatility this year, and taking safe harbor in those higher quality names seems like a good idea to me. So we'll see if that plays out. We'll certainly hope to get a chance to talk to you again before the election actually occurs. But Thomas, I want to thank you so much for the time today. And again, we'll talk soon.
Thanks for having me, Ross. Good to see you.